It's Sunday, December 29th, 2019. Welcome to All About Your Benjamins and your weekly mixtape and weekend review video. I hope you had a great week of holiday celebrations, whether it's Christmas or Hanukkah, spending a lot of time with your family, safe travels to and from wherever you might be going, and hopefully you've avoided the flu. My family has not. 3 out of the 5 the last couple days have been knocked out, feeling achy and not feeling very well. This morning, Roman woke up, told me he was feeling achy. So it looks like I might be the lone survivor, but nonetheless, we've had a great few days of just spending time together, relaxing, not doing too much since everybody was feeling poor. Hopefully you've avoided that, but everything else has been great for you. Short week with the holiday, only a couple articles to get to, so let's real quickly get to the articles and headlines that may or may not be impacting your financial planning and portfolio. And I have a couple thoughts I want to hit too as well. But the articles first, the first one just talks about the markets closing last week at highs. The NASDAQ crossed 9,000 for the first time. So we are heading into the last week of the year at all-time highs or near all-time highs, depending on the benchmark you're looking at. If you were to think back last year this time, the 20% or near 20% bear correction that we had November into December, mostly December. I don't think you would have thought this year would have been such a great year with the markets right now, if the year were to end now, up 20+% across the different U.S. markets, and then small caps doing real well, international doing pretty well also. I don't think you would have thought this year's performance in the market would have been what it was. My fear is there were a lot of people who got out last year in a panic, didn't trust that the market was going to do what it was going to do this year because they listened to headlines or whatever it might be, didn't have a financial plan to help them, and missed out on another great year. So I just want to bring that memory back up because inevitably we're going to have another period where the markets are shaky. There's going to be headlines that make us think the next recession's here or the next big crash is here, but it may not be the right thing to do to act on those emotions. So it all comes back to having a financial plan, being a diversified investor, and going into the long term, not making short-term reactions to what's going on. So nonetheless, we head into the last couple of days trading at highs. We'll see where things end. No reason to think there's anything major that happens in the last couple of days, but you never know. One thing I will put out there is with a year of a lot of great gains, especially if you're an individual stockholder, there's some stocks that did real well. You could see a sell-off early in the new year. It doesn't mean anything major, but just that people take their gains in a new tax year and then begin to reposition their portfolio for the upcoming year. Not a lot of individual investors like you and I are going to be doing that, but the big traders out there might be doing that. And you'll hear people talk about that. To be honest with you, I don't know how much that actually moves the market at the beginning of the year, but you could see some things like Apple being sold off at the beginning of the year because it did real well. And that's not a recommendation, but that's just an example. It had a great year. A lot of people own it. They might want to take some gains in the new tax year and then begin to reposition the portfolio going forward. So just something to think about. If the beginning of the year doesn't continue the momentum that's leading right now, who knows what's going to happen. The other thing I wanted to mention, we talked a lot over the last year about wages and the labor market and how strong right now the employment market is. The last article talks about lower income positions having a big raise in income over the last year. So in the last month, it was up 4.5% year over year as far as wages. So the wage game begins to continue, or I guess continues to remain strong. If you think back to last week's Week in Review, I talked about consumer sentiment. Consumers are feeling good about their situations right now. Seeing their wages go up is a positive that helps that. So we're continuing to see a strong labor market, which when the labor market's strong, that means there's not enough hirees or not enough employees for the open positions. Supply and demand tells us that those employees, those workers are able to begin to command higher wages because there's not enough people in to fill those positions. Now I know not everybody feels that, not every industry has that right now, but on a whole, the overall labor market, the jobs market is looking very strong and we're seeing wages go up with that. The one thing I wanted to put out there is, I mentioned already, I covered one of them, just thinking back to last year's market. Don't expect this market to continue to do what it's doing forever. Having 9 out of 10 years or 10 out of 11, I didn't really do the math real quick, of double-digit gains in the market has been great, but it doesn't necessarily set the expectation that that's our realistic expectation if you look at historically what could happen. So, not making any predictions, but just don't get caught up in seeing big gains a lot over the last 10 years and expect that to be the next 10 years. we never know when that tide is going to turn. We don't know when we can get back to regular 6-7% portfolio growth. So just wanted to put that out there. Another thing I was going to remind you of is if you get your performance reports, so January, you're going to get your quarterly statement. You're going to see potentially what your performance was year to date. You hear about the market's up 20+%, and you're only up 10, 15, 18%, and you want to know why. Remind yourself of what those benchmarks you're hearing on the TV represent, large U.S. companies for the most part. And if you're a diversified portfolio holder, you have bonds in there, you have small cap stocks, you have international stocks, you have diversification, so you're not going to be at that high level, and I think that that is okay. If you're a retiree, your goal probably shouldn't be to get 20% in a year like this year, because that means you're taking on a lot of risk, concentrated risk into large U.S. only. When things turn, when it is another December of 2018, you're going to fall a lot harder. And if you're retirement, your goal is probably not to make as much money possible in your portfolio. It's probably to grow enough money to provide the income that you need, maybe meet some legacy needs that you want to have as far as estate planning goals, but it's not to make the most money. So just remind yourself when you hear those benchmarks, or you're at a holiday party talking to somebody and they're bragging about how much they made, and if you're not making quite as much, you don't know all the factors. You don't know how much risk they took. You don't know what else went into the portfolio. Just know that you have a portfolio hopefully lined up with a financial plan that is going to give you the growth that you need to reach your goals. And any added growth beyond that is a bonus, but you don't necessarily want to chase those high returns, because that's probably not what's the best thing for you. Being greedy and trying to get the highest returns usually ends up in a lot of pain later on that may make you make a decision that impacts the portfolio long term, offsetting those gains you may have gotten a year like this year. So advisors are going to explain this to you. It seems like it's a cop-out, but at the end of the day, our job is to help you create a plan, align a portfolio with it to reach your goals. And your goals probably do not need to have high risk in later years of your life. It's more about getting good growth and also having diversification to help out with protection. Having enough on hand to send you your monthly checks if you're living from your money. So this is a little bit of an explanation for the retirees out there. Young professionals, I think you should be more aggressive. Put it in there, forget about it, keep saving. But that's not kind of who I'm talking to right now. This is more towards the retirees or those using their money today. So, end of my rant. We'll let you get to your week. Hope you have a great new year. Look forward to continuing the weekend review going into 2020 and seeing what this next week brings. It'll probably be a shorter one next week because I won't be on my soapbox telling you all these other things. But thanks for watching. Be sure to subscribe. Be sure to check out the mixtape below if you're on allaboutyourbenjamins.com. If you're watching this on YouTube, head to allaboutyourbenjamins.com. The link is in the comments to check out this week's mixtape. Ben Carlson talked about last year's bear market, which I think is always good. My comments combined with that would be a good reminder of what happened, just to prepare ourselves for when things really do go and remind us that the market doesn't always go up. So with that, hope you have a great Happy New Year. We'll see you in the next episode.